and jump into our regular programming here so we don't keep you all here all day and all night. But today, as you know, we are going to be talking about buying with no money down and no mortgage. Very, very exciting topic today and very excited to bring it to you. So let's go ahead and jump in. Let me go. Oh, perfect. Um, just a little bit about myself. My name is Tia Honeycutt. I am the broker and founder of Proximal Realty Group. We're located all throughout all 9 Bay Area counties, but we started here in Oakland, and our one of our main goals is to bring homeownership and home ownership to the larger group, to society in general, and in particular to the Black community. So we really want to focus on strategies for increasing home ownership as owning assets is really the way to challenge some of the narratives that we see moving forward. So we're really excited to be able to bring that to you today. Um, um, while before we begin, if you're not already following us on YouTube and Instagram, here are the QR codes. So please take a moment, sign up for to follow on YouTube and Instagram. We do a lot of educational programming there, a lot of fun stuff, some trends things, some good ideas, finance ideas, just ways to kind of position yourself in this economic environment, which becomes more and more challenging as the days go by. So please do follow us there. Today, we are going to talk about how to buy with no money down and how to stay in the property for either no or very little mortgage. So we're going to cover how important it is to work with a realtor. We're going to talk about the concept of local and state down payment assistance programs and federal in some cases, how income producing properties will help you eliminate your mortgage, and then we'll have time for Q&A at the end. So, nowadays, why does buying feel so impossible, right? Everyone hears about the interest rate. They get confused between the interest rate and the mortgage rate. They think when interest rates go down, that means that mortgage rates should go down. There is somewhat of relationship between those two, but the interest rate, and I'll just deviate just for a moment so that folks can understand the difference between the interest rate. That is what the banks borrow from the Fed at, right? That is not what your mortgage rate is going to be. The mortgage rate is what you are going to be borrowing from the bank at. Right. So there's a difference between that prime rate that we hear about all the time and what mortgage rate is offered you, because in a sense, that's the bank's profit. Right. And that rate is actually more closely tied to the 10-year treasury. You'll hear every now and again they mention the 10-year treasury. The mortgage rate is more closely tied to that than it is to the prime rate. And so the 10-year treasury is also can be referred to as a recession indicator. And fortunately for the economy, there is no sign of recession on the horizon. But what that means for mortgage rates is that it's very unlikely that we're going to see too much movement as far as mortgages in the downward direction. So they've been hovering around 7. I've seen as high as 7.25. Some of the quotes that I'm going to give you later are based on 7.25. They are saying that they're probably going to float down to 6.5 or 6% this year. But as you can tell, that's not a big difference, right? If they do, the most optimistic scenario for mortgage rates is that they will be down by 1.25, which is just a couple $100 a month, right? And that's not going to make the difference when it comes to really substantially altering your monthly payment, or as we call it in real estate, your monthly nut, right? What you have got to meet every month to be able to stay in your property. So that's another reason we wanted to give this training, was a strategy for combating the high prices that you're going to have to pay because we have a historic lack of supply as far as housing is concerned. So that's keeping those housing prices high. And also then once you get into the property and you've got this big ginormous mortgage, how are you going to make it, right? So let's talk a bit about that. So first and foremost, I want you to realize that yes, you absolutely can and should look into purchasing a property so that you can live in it. There are a couple of great benefits that you get from living in your own property. Number one, you control your own destiny. Right? If you are renting, your rent inevitably is going to go up and up and up. And maybe there's going to be a time in your life where your income is no longer going to be going up and up and up, and yet you still will have committed to this property where the rent is going up. The great thing about a mortgage is that once you get in that 30-year mortgage and you pay that mortgage, that's it. It's not going up. That is the number that you have to meet. Right? So you lock in a set payment amount that you have to pay for the next 30 years for your housing. Meanwhile, the housing itself is appreciating in value. And that appreciative value, what we call equity, is yours. It doesn't belong to the bank. It doesn't belong to a landlord, right? Because we got to get rid of the landlord. It is yours. So that's a really exciting concept to think about. Then there are all the intangibles or less tangible, right? Pride of ownership, being able to know that the place is yours. If you want to paint the wall purple and then another wall black and another wall chartreuse, it's your property to do with what you want. It means that you also have a responsibility to maintain it and to make sure that we can craft a budget so that you have room in your budget to maintain the property, but it is yours, right? If you want to get a dog and you have a property that is either a single family property or a condo that allows for, pets, you can have a pet, right? Whereas oftentimes when you're a renter, there are restrictions or they can just flat out tell you no, pets aren't allowed. So there are a lot of benefits, both financial and emotional, to owning property. And then, of course, you have the concept of generational wealth, which is when you strategize, you get in there, you stay in there, then you have something you can pass to your children. And, when you hear people talk about net worth, your net worth is the amount of your worth minus your debt. So that's minus any loans that you have on your car or your property or whatnot. And the biggest gainer of net worth for any American is the property that they own. Because if you sit in it, you take care of it, you pay your mortgage, there becomes a difference between what you paid for it and what it's worth. It goes up over time. Even when you have those historic downturns, as we did in 2008, and we had another one a few years ago, those are usually transient, meaning that they happen for a certain period of time and then they're over, and then it's back to the property appreciating again. So if you look at it over the long term, you see people that bought properties in very swanky areas for 75,000 back in the 80s that are now worth $2 million. Right. And that's very common, especially here in the San Francisco Bay Area, which is where, by the way, I am going to be uh, um, aiming my comments towards the San Francisco Bay Area, where we see extraordinary appreciation on properties generally. And your area might be different. So that is why it is important to, number one, work with a realtor, right? Because a realtor knows your area. They know what the trends are. They know generally what the prices are, what you're likely to be able to obtain a property for. They also will guide you through the home owning process. So I think, or home buying process, I think a lot of people are confused or maybe have had experiences with bad realtors who are trying to shove them into properties that they have no interest in. A good realtor is going to listen to what it is you're looking for, look at your budget, and see what you can get for the budget that you have. They're not going to try to make you spend more than you have. They're not going to try to put you in a property that has less bedrooms than you need. And that's why you want to make sure that when you're doing your interview process, you're both picking someone who's fun to hang out with and who is nice, but who also is really in it as a buddy, right? You really need a buddy more than an expert, right? It's very difficult to be an expert in real estate because the every buyer is different, every seller is different, and every property is different. However, you can be the type of person who will make the effort to research the property, to research the best scenario for your client, and really have an outcome that people are happy with. So those are things to look for with a realtor, but they really do have resources available to them that the public does not. And that's another reason that you really want to work with a realtor. They'll put you in touch with all of the people, and there is a universe of people now when we're undertaking this process that we're going to need appraisers, inspectors, lenders, gardeners, painters, all of these people who are going to help us get through this process successfully. So work with a realtor. Now, number two. This is strategy number two, and this is something that very few people know about. I do videos about this all the time. There is also a universe of down payment assistance programs that are available to people. At last check, I believe there were 600 programs that are available to people in the San Francisco Bay Area. Why? Because we have city programs. San Francisco has programs, Oakland has programs, Richmond has programs. All of these different cities and municipalities have programs. On top of that, the state of California has programs. So, and there are a number of programs. Some of them are based on income, some of them are based on where you are, and some of them are none of those things. Some of them you just have to be a first-time home buyer. And the great thing is that when they mean first-time home buyer, they don't mean first time in the history of your life. They mean that first time in the last 3 years in some cases, and 7 years in other cases, right? Now, some of them you can't currently own a property, but some you can. So you'll need to talk with your lenders, of course, that we will put you in touch with, who specialize in these type of programs about what programs are available and this universe of programs. And again, there are also federal programs. Now, the federal programs, unfortunately, do kind of come and go, and we're not sure what the incoming administration will do. We had some great programs within the last couple of years, and we're looking forward to seeing what's happening, what will be happening coming forward. But that's the great thing about being in California is that there are always opportunities available to folks that have been funded. And that was one of the first things that was funded in the budget were things to continue to support home ownership. Because it is something that really stabilizes. I think that our California government was able to see that homeownership really stabilizes our communities, right? And gives folks an ownership stake in what's going on in the communities and also keeps, folks out of poverty if you own a property and you have a good, affordable mortgage and a strategy for affording your mortgage. And that's something that we're going to talk about a little bit further today. So specifically, the types of programs that are available, some of them are grants, meaning they just give it to you and that's it. Some are loans. They appear as a second loan on your mortgage, and you have to repay them as you go along. So you're paying your regular mortgage and this down payment assistance loan as well, but it's a very low percentage in relation to your first mortgage, right? So you might only have to pay a couple $100 on it as opposed to, a couple thousand, which would have been more in line with what a normal loan would have been. Some of them are forgivable loans, which means that after 5 or 10 years of you owning the property, if you don't sell it or refinance, they will just wipe it clean, right? And again, because these are programs that are coming from government money, wanting to beef up home ownership, to stabilize the economy and stabilize folks in the economy. So it's a gift, right? And as long as you're not trying to flip or, use it for some sort of business purpose, they will wipe the slate clean of that loan. You'll still have your first mortgage, but they'll get rid of the down payment assistance loan. And then some of them are tax credits, right? Where you're still having to be able to afford the down payment, but you'll get a credit on your federal taxes. So these are some general kind of categories. Again, the specifics are why you're going to want to talk to a lender and who specializes again. And this is why it's important when you talk to your realtor, make sure that you are asking them for lenders that specialize in down payment assistance if this is the strategy that you want to employ. Because there are plenty of lenders, just about any of them can probably get you a loan. But you're going to want to go to folks that really have an understanding of all of the different programs. And different lenders will have different programs. This is another thing that folks don't really understand is even if you decide not to use down payment assistance, because usually you might have a little bit of a hit as far as interest rate or you're owing more or whatnot. Um, you will still have a situation where lenders have different loan programs available to you. So it's not always about the credit score or the debt to income ratio. It's really just that different lenders have different programs available to them. So that's why when we come to you as your realtor and we say, here are three names, we really need for you to call those three people and to see what programs they offer so that you can figure out which one is the most strategic for you as far as how you want to approach this. And so we really want to make sure that you understand that you're in the driver's seat and you're in control here. And we're going to try to pick the best strategy based on the information before us for how you want to go forward with this. But the strategy that I am wanting to look at today and talk about today is where you do use down payment assistance, whether it's a grant loan or forgivable loan, towards knocking out that down payment entirely. And there are absolutely programs where you can come in and pay nothing as far as your down payment. Now, another thing that I will bear to mind is you want to start this process sooner rather than later. Because some of these programs, most of them, require some amount of classes that need to be taken. They're either in person or they're online. Some of them are 8 hours. Some of them are a number of hours, a number of sessions over time. So you want to make sure that you haven't like put in the offer on the property and then you're like, okay, now I'm ready for the down payment assistance, right? So you don't want to put the cart before the horse in that sense. It's still always a good idea to kind of look on your phone and see what properties are coming up in a sense of what you think you might be able to afford and whatnot. But as far as the process of obtaining the down payment assistance, you want to do that first so that you're ready to rock and roll when you find a place. And finding the place is probably going to be one of the fastest, maybe not the shopping, but as you refine what you're looking for, know what you can afford, start looking in areas, you start to very quickly become an expert shopper. And within 3 or 4 offers, which is generally my experience, you will be in contract. So we want to make sure that you've got everything in place prior to doing that. Now, this is the second part of the strategy. So you've already locked down your down payment assistance and are ready to go as far as knocking out your down payment. The first thing that people tend to do when they look at property is they look at what we call a single family detached property, which people in the general public tend to call a house, right? And houses are great and they're wonderful. And they are definitely an ownership goal. But as far as being able to live in a property that you own, that you are not paying a mortgage for, it is a much better strategy to look at a multifamily property, what we call multifamily or income producing property. Now, the great thing about this strategy is if you pick something that is 4 units or less, that is considered an FHA quote unquote property, and it is available for first-time homebuyer assistance. And you can also finance it the same way that you would a single family property, meaning that you can put down whatever you want, which in this strategy, we want to put nothing down, right? So the actual strategy for doing it is you're going to pick a 4 unit, 3 unit, or 2 unit. Look at the income that you're getting on those additional units, and that's actually what's going to pay your mortgage. And FHA, it will allow you to buy that property as though it were only 1 unit. So it's just like buying a house, except you're actually getting income as well. So the one that I really love is the fourplex, right? Because now you've got 4 units one of which we're saying you're going to live in, right? You do have to have the intention to live in there. You do have to communicate that to FHA that you do have the communicate the desire to live in one of the units. But even at that, that's 75% of that income. That's three other units that are going to be contributing money towards your mortgage. All right. So let's take a look at what that looks like. And so what we'll do is we'll take, if we have something that's, assuming it's a two-bedroom, one-bath unit, all right? And let's assume that all of them are two-bedroom, one-bath. There's four of them, okay? In Oakland, the typical price, rental price, lease amount, rent for a two-bedroom unit is 2,500, right? So if we multiply that times three, we're at 7,500. And let's wipe the owner's unit, say you're not contributing anything, not a penny towards your mortgage. Well, if you did get this, rate of 7.25, which, we don't love, but, it's better than what it would have been, 20 or 30 years ago. Um, your monthly mortgage would be 7,500 if you bought a property around 900,000. In this particular instance, I used a Zillow calculator at 7.25, and your monthly mortgage would be 7,500 for a property at 880,000, right? Which is almost 900,000. And that is actually, there are some fourplexes that fall in that category in the area. You might have to look at Oakland. You might have to look, outside, a little bit outside San Francisco, right? To be able to find a property at this price. But, that's a pretty hefty mortgage, right? But if you use an FHA loan, which a fourplex qualifies for, and receive down payment assistance for 3.5, because if you use an FHA loan, you can go all the way down to 3.5%. If you use down payment assistance to knock out that 3.5%, now we're in a situation where we have paid zero for down payment and we are paying zero for the mortgage. Now, of course, you can, even juice your equity and your input and your savings even more if you say, okay, well, I'll pay 500 a month towards my mortgage, and I'll take that other 500 from the rental and use that as the budget for fixing the property or whatnot. You can move these numbers around a bit if you contribute towards it again, but you can see how you can contribute absolutely nothing yourself except time and effort, right? And money to qualify, right? And your income to qualify. But here's another thing now when we talk about qualifying, the great thing is if each of those units is bringing in 2,500 and you're saying, I'm going to live in the owner unit, the bank will say, okay, we will take 75% of the income and use that to help you qualify. So now what the bank is saying is this 7,500 a month before you've even owned the property, we will say, yep, that is part of your income, and we will count that towards you qualifying purchasing this property. So maybe if you were a little bit short as far as your income was concerned, to be able to qualify to purchase this property, the bank is like, no, we get it. There's already three people there paying 7,500 a month. So that is going to help you qualify to be able to get in the front door even before you've owned the property. So that is huge, right? Because maybe you're making 100,000 a year, let's say. You're making 100,000 a year. And, that's maybe not going to be enough to help you qualify for the 900,000 if you're not coming in with a down payment. However, now we get to add almost another 100,000 to your income because we get to use 75% of the income of the property. And that will put you in a better position as far as being able to purchase the property in the first place. All right. So again, 75% of the income of any of your the multi-unit property can be used to help you qualify. And in the example I showed you, it covered all of the mortgage, but you can also use it to cover less and then bring in more money yourself. Now, a lot of folks find this first step 20, 30 years from now step as far as owning property. And they are attracted to the duplexes. So when you look at duplex prices, they tend to be very high. Maybe not quite as high as single family, but I noticed particularly San Francisco, Oakland, those duplexes are expensive. Why? Because people are thinking about the idea of using the rental income to both qualify and cover their mortgage. And they're like, oh, well, I only have to deal with one other person. Right. So what some people will do is buy as a group. They'll buy with friends. I've even seen couples and one side of the couple will take one side and one side will take another, especially for our LGBTQIA community. There are folks that work that strategy as well. So they have their own units, but they live together and then they, maybe raise kids together and they kind of run back and forth between the two units, which is a great strategy as well. So, you will notice as you're out there looking, and particularly in the San Francisco Bay Area, that those prices are quite high. However, as you start moving out a little bit, maybe a half hour, maybe an hour, from San Francisco, Oakland, you start to see those prices really drop. Because people are not as aware of the multifamily strategy. And then, of course, the reason I was showing you the fourplex is because you really max out the strategy then. And I love this for first-time home buyers because a lot of first-time home buyers don't have family, right? They might be single, or it might be someone and a partner, right? And in a situation like that, you can really max out this strategy because maybe you get a fourplex, maybe as the owner's unit, you take a one-bedroom unit because not all fourplexes are two-bedroom, one bath. Some are one three-bedroom unit, a two-bedroom unit, a one-bedroom unit, and a studio. Right? So you may decide that that three-bedroom unit, you want to rent that out and get 3,500 a month for that one. And then you got a two-bedroom, you'll get 2,500 for that one. And then maybe you're happy enough in the studio, or maybe you're happy enough in the one bedroom. But you see, there's a lot of flexibility here for how you can move those numbers around and really make it work for you. Now, an important caveat is that you do have to live in the property to be able to purchase the property as an FHA owner occupant loan. And that owner occupant loan is what really lets you get all the way down as far as your down payment is concerned, and then be able to use that for the down payment assistance. And my understanding is that the majority of the down payment assistance programs are owner occupant programs. So they are expecting you to live in the property that you own, but you can still avail yourself of all of these opportunities. Now, if you're just interested in purchasing investment property and you already own your property, you have no intention of living in the property, then generally they're going to be looking for a 25% down payment, which because it's considered an investment property. And then what I like for investors, honestly, are 5 units and more because they're commercial units. You do tend to see a steep drop off in prices from 4 units to 5 units. And that's because once you tick up to that 5 unit number, that becomes a commercial property. And there's this much smaller pool of folks that might be looking to buy those properties. So I see like 5 units to 10 units maybe, or up to 25 units. Those properties do tend to be, I think, undervalued for the kind of income they bring in. But then it's a whole nother ballgame as far as running the property is concerned, right? You want to probably bring in a property manager. We have property managers as well that can help you with that because it becomes a very large job. It's a lot of doors. It's a lot of people calling at 11 o'clock saying I clogged my drain again, even though I washed my hair and let it go down the drain as you told me not to do many times. But it becomes a different kind of management strategy. So that really is more for investors. But that opportunity is available as well. So I have been talking nonstop for an entire half hour. I am going to give everyone an opportunity I'm just going to stop sharing my screen quickly to see if anyone has questions about what I put forward, thoughts, anything that was confusing in the way that I explained it. I'm opening the floor.
No, this is Dr. Veronica Honeycutt, and an excellent presentation, by the way, Tia. Uh,
Thank you.
uh, the FHA information is very interesting. Okay, so what I want to know is since there is a requirement that you have to live in one unit in order to be able to take advantage of this opportunity, is it possible to kind of somewhat live in the property, like, you set it aside and move in and, maybe live there for 3 days a week, but you want to reside in another property for the rest of that time? Is that an issue? I mean, I don't want to lie. I don't believe in that. I believe in just, telling the truth and let everything fall where it might. But is there a requirement that you have to reside in the property for a certain specific time on a weekly or a monthly basis to qualify as an owner occupied property?
Yeah, so what I would strategize, there's a couple ways that you could strategize with that. Number one, you can see if you can get your lender to go along with that, right? Because maybe there is like a 60-40 or something that I'm just not aware of.
Hmm.
So that's one strategy that I would put into play. Number two, I would also think about your family members. So
Mm,
if you have a family member that doesn't own property,
mm,
that you want to use this strategy with, you could always co-sign with that family member, even though you're co-signing, that doesn't mess up the FHA owner-occupant aspect. Do you see what I'm saying?
I do.
So you can purchase with another family member that does not currently own property, then use a property manager to manage the property. You do have 60 days, to move into the property, right? And then some things happen in the 60 days. But those would be the two strategies that I would employ.
Mm,
Is I would either ask your lender if there's some kind of ratio that you could employ to say, oh well, I'm using it for a certain period of time. It's a pied a terre. I live in a different city, but I'm
mm,
here, for a certain amount of time, and I need a place to stay while I'm here. This is my home office while I'm in town. Or number two, pick a family member that doesn't currently own property, buy with them,
mm.
have them take out the FHA loan, and then you can use your income assets or whatnot to support their purchase of the investment property.
Okay, and I could still get in theoretically on the no down payment.
Exactly. Right. So they would have to do the down payment assistance classes.
That's and that's excellent. I
Yeah.
really like that.
Right.
So we want to generate wealth, and we want to help our younger people. Since I'm much older than all of you probably on the call, we want to make sure that they have an opportunity to own property and to have an opportunity to make money legitimately through
Exactly.
the acquisition. So thank you so much for that response for that answer to that answer.
Of course. Of course. It's a great question. Great question. Antoinette.
Yes, thank you, Tia. I kind of want to piggyback off of what Dr. Honeycutt, the question she raised. So getting in, I understand the requirements, you have to live in the property and so forth. But what if after a while I decided I want to move? And I know it's a matter of, I guess what, honesty or any or whatever, but would I be required to live there for the life of the loan?
Mm-hmm.
Right. Also, great question. I have never heard of anything like that. I've never heard of a situation where there was any kind of a requirement for occupancy for a certain period of time. So, I don't want to say I don't want to speak on behalf of the banks, but usually they're quite happy to see their money coming in regular. Usually what happens with these banks, as we know, is you get your loan from them. It's called origination. You originate your loan with them, and then they sell it 10 times, right? So they kind of don't care what you're doing as long as their money is coming in, right? So that's what I would say. I've never heard of like the FHA police, or the Chase Bank police, that come and knock on every door and say, so and so took out this loan. Where are they? Where are they? I need to make sure that they're in this property. You know what I mean? So, and I'm kidding about it, but I really haven't. I've never heard of a situation like that. As I said, once you kind of get through the origination process and you've got your loan and you're making your payments, as far as they're concerned, you're performing, and they actually literally call it a performing loan. you know. So, that is how I would respond to that question. Hopefully it answers your question.
It does. Thank you.
Any other questions before we keep it going? All right. So, am I still sharing here? Let me see. I don't think I'm sharing. I'm going to share it again. Just to, oopsie. Let's see. All right, so thank you so much for joining today. I A few they call them call to actions for you. First and foremost, nobody does it now, but people used to do it where they would start with the realtor. But right now, everybody starts with the looking, and that's great too because you do need a certain level of sophistication to get through the process and find the property that's going to work best for you. But then please do not put off talking with a realtor, and really view it as an opportunity to shop and find someone who you're going to enjoy spending time with and who you want to make sure is your advocate. So make sure you start. Or if you haven't now, start with looking for your realtor. Number two, please, please, please start getting your down payment assistance information sooner rather than later so you can knock out the classes. You might have to do three or four different classes because you might be looking in San Francisco, you might be looking in Oakland, you might be looking in Richmond. There are many more places. Stockton probably has programs as well. There's a lot of different places that have down payment assistance programs, but as you're looking in all of these different places, you're going to need to make sure that you are able to avail yourself of the down payment assistance programs in those cities, as well as, and this is very important, I didn't mention this earlier, you can layer these programs. So my strategy as I laid it out there was just if you cover the 3.5%. And what that does is it tends to make your mortgage higher, right? It's like a balloon. If you push down and you put less down payment, then your mortgage is going to go up. If you put more down payment, then your mortgage is going to go down, right? So in some cases, and the last one that was just offered that I was even able to avail my clients of was the one where they were giving you 20%, which was huge. And it was a lot of money. People were getting up to 100 and 150,000. That was either just going to sit there until they sold the property or was going to be forgiven after a period of time. I'm not sure what the details were because many of them are different. But that's huge. Because what people were doing was they were able to take 100,000 from there, they were able to take 10 from another one, take 20 from another one. And what that did was made it not only so that they didn't have to come in with a down payment, but it made their mortgage even less, right? So when you couple that with working on a multifamily property, then you put yourself in a situation where now you're cash flowing and you're not an investor. Investors call it cash flow, where you're getting more money in your hand than what your mortgage is. So if you can layer some of these down payment assistance programs, which you absolutely can layer your California programs and your state programs and your federal programs. You can have four down payment assistance programs if you qualify for all of them and if they allow for that. But in a lot of cases, I'm seeing a lot of people now layering two and three down payment assistance programs because they're city, their state, and they're federal. So please do that research and enlist the lender. It's not really the realtor who can do it for you. The realtor is going to put you in touch with the lender who can do it, but it's really the lender that's going to do that for you. And then also when we talk about the city programs, a lot of times you can just search local down payment assistance, or if you're looking in the city, San Francisco down payment assistance, and those programs will pop up, and you can just reach out to them directly and start doing your classes. And I really wish people would do that before they started looking for property, so that they really understood what was available to them, had that in their back pocket. And then when you go to the realtor, you can say, oh, well, I've already taken my classes for such and such. You may or may not use it, depending on whatever property, but at least you have it done. And then you're not in a situation because sometimes these programs, they're only offered at certain times. They might be quarterly, they might be, whatever period of time. You don't want to be waiting around to take the class. You want to have the class done and then be ready to avail yourself of the funds. And then, as I said, income producing properties, even if it's just a duplex, right? Just something that's bringing in some income, because our income fluctuates. right? And so if you put yourself in a single family property, that's great. But a lot of the downfall that you hear about folks that buy houses is because they're all the way at the tip top of their budget when they purchase the property, and then they lose their job. Or they are given start getting less hours because the company is reorganizing or this or that or whatever, right? You're really kind of trusting that your company is going to continue to have the relationship that they have had with you in the past. And we're realizing more and more now that that's not really a great strategy as far as budgeting is concerned. So please, please don't forget to look at those income producing properties. Again, my name is Tia Honeycutt. Here's my phone number. Here's the QR code for our website. If I'm not available, I will always put you in touch with one of our amazing agents. We have folks out in Stockton, we have folks in Antioch, we have folks in Vallejo, really all over the Bay Area that are ready to assist you and get you going in your home ownership journey. And again, here's my social media so that you can see all the fun stuff that we do on there. And there'll be some surprises and prizes and fun things to be able to enjoy. So thank you so much. And please do enjoy your weekend. If you have any questions or comments, please don't hesitate to reach out. And here's to looking forward to a great 2025 and on to your first or next property. So enjoy, have a great weekend, and look forward to speaking with you all soon. Take care.
Thank you so
Thank
much.
you. Take care. All right.
Mm.
Bye. Bye.